Herman and Jim Mack here from Eisner-Amper, and they're going to be presenting on the order-to-cash process. A few quick things to get out of the way before we get started. If you do have any questions throughout the presentation, you can feel free to either put those in the questions or chat function, and we'll be sure to take all those and ask them in a Q&A session at the end of the webinar. Also, we do have a very brief survey that will pop up as you're exiting the webinar. It takes about 20 to 30 seconds to fill out, but it gives us a lot of great insight into how we can continue to make these presentations better for you. So with that, I'm going to pass it over to Ken Frisco, and he's going to introduce our speakers.
Thank you, Justin. Okay, so I'd like to just give you a brief background on our two speakers today. Jim Mack is a partner in charge of the firm's consulting services group and a leader in the insurance industry practice. He has broad experience providing audit and consulting services to companies in the financial services, life sciences, and energy sectors. With 25 years of experience, Jim is a seasoned client service professional with extensive expertise advising senior executives and boards of directors on how to navigate emerging accounting and regulatory rulemaking. He has served as the outsourced internal audit leader for several New York Stock Exchange listed entities and directed dozens of Sarbanes-Oxley 404 implementations. Prior to joining Eisner-Amper, he was the president of the West Valley Group, which specialized in assisting senior executives in making their operations more successful through the use of enterprise risk assessment, CFO support, and merger integration solutions. He earned a BA in accounting from Widener University, where he continues to remain involved as a member of the Board of Trustees. He is a member of the American and Pennsylvania Institutes of Certified Public Accountants. And our next speaker is Kristen Herman, who's a senior manager with more than 10 years of experience in finance and internal audit. As a member of the consulting services group, she conducts risk assessments, develops business process narratives, and identifies key risks and controls. Kristen designs internal control test scripts and conducts testing for companies in the insurance, pharmaceutical, manufacturing, life sciences, banking, and not-for-profit sectors. Prior to joining the firm, Kristen was an assistant director of financial services in the hospitality industry. Her diverse background allows her to identify and report internal control weaknesses and develop customized solutions for clients. Kristen is a graduate of Rutgers University with a BS in accounting and a BA in economics, and she's also a member of the Institute of Internal Auditors. So without further ado, I'll turn it over to Jim Mack to start the presentation.
Thanks, Ken. And good afternoon, everyone. Just go over the agenda real quickly. We're thankfully through those introductions, and I'll go over a little bit of what is Sarbanes-Oxley, what is SOX, where did it start, where has it gone, and where do we see it going in the future. And then we'll get into the meat of the presentation about documenting the order-to-cash process, how we go about that, what some of the sub-processes are. Talk a little bit about IT application controls. Those are probably less likely to be handled by you. However, knowing what the key areas are that auditors might be looking for, I think, is important. So we'll talk about that a little bit and talk about some pitfalls. So the beginning of Sarbanes-Oxley, really, as we got into the end of 2001 and Enron occurred, the fall of Enron and the subsequent conviction of several of its executive officers, the demise of Anderson, was really the start of what became Sarbanes-Oxley. And there were other major failures around that time, WorldCom. And WorldCom was really the one that gave rise to the Sarbanes-Oxley Act. While Enron was major, impacted a lot of people. Politically, the sight of Bernie Ebbers testifying before Congress, being defiant, acting like he didn't do anything wrong, that the company didn't do anything wrong, was really what created and pushed the political winds towards having an act like this. And as Congressman Oxley, who was one of the co-sponsors, said, when Bernie got on TV, he was getting calls from the White House, he was getting calls from people in his district, and they wanted blood, and that's really how we ended up with this act. It was passed in July of 2002, and I remember at that time reading through it. I had a flight, I believe, from Philadelphia to Chicago, and I read the entire act, and I just said to myself, holy cow, there's a lot of change here. And if this thing really gets implemented, it's going to affect my profession as a CPA. It's going to impact my clients. It's going to have a significant, far-reaching impact, and it's going to cost a lot of money. And I think, sure enough, that has happened. I think what they were really getting at was putting in rules and laws that allowed people to be held for broader liability, broader criminal liability for corporate misrepresentation and fraud. And there were fines up to $5 million. There's different provisions that were kicked in at that time. And what you've seen in the last 13 years since it was put into place, almost 13 years, is that the perp walks that everyone assumed would happen, the enforcement, the conviction of CFOs, CEOs, audit firm partners, and things like that really hasn't happened, I think, at the level that people expected it to. And what you really ended up with as a result of it was two real and lasting changes. And one was the implementation, the creation of the Public Company Accounting Oversight Board, the PCAOB, which essentially turned the part of my profession, the part of the accounting profession that audits public companies, into a regulated industry, regulated by a board of 5, only 2 of whom are permitted to be CPAs. Over the course of that time, most of those 2 representatives who were CPAs were people in other professions who happened to have a CPA. They weren't necessarily practicing accountants, and that has really changed the way my industry has been run, and that is a lasting and really profound change. The most significant change as it relates to companies, to registrants, is Section 404. And that's what we're going to talk about today, which really requires management to can we switch slides? Management to assess and report on their internal controls over financial reporting. And this element of the Act does not apply to smaller companies, companies with market caps under 75 million, and also with the Jobs Act, that exemption has been extended to even larger companies. But it does capture the great majority of the market cap of public companies. What are we really looking at? This is, as we talk about internal control frameworks, in the early 90s, the Treadway Commission put together an internal control framework that's called COSO, the Commission of Sponsoring Organizations of the Treadway Commission, that gave an outline and a framework for internal control assessment. And what Sarbanes-Oxley, the only thing I really want to talk about that in this context is that Sarbanes-Oxley deals with internal controls over financial reporting. As you can see from this cube, there's also internal controls over operations and compliance. Internal controls under Section 404, the assessment of internal controls under Section 404 only relates to internal controls over financial reporting. So it's not the entire world of internal controls. It's just that one section. So what is SOX? Management has to accept responsibility for the effectiveness of internal controls, evaluate them, have evidence to support that they have evaluated, and then present a written assertion that says we have done all those things, and these are our results. What this also means for most companies is that they need to present that information to their external auditors, and their external auditors are required to sign off. And the assertion, the attestation happens in several ways. One is Section 302, which is the quarterly reporting. If there are any changes in internal controls or material weaknesses, then companies would have to report that. And then Section 404, which is the annual assertion. What has happened with Sarbanes-Oxley, just a little bit of a couple statistics. The Financial Executives Institute did a survey last year where they polled CFOs of not just public companies, but all companies. 83% of them thought that the Sarbanes-Oxley Act had increased investors' confidence, which I think is pretty significant. Generally, there are some cost-benefit studies that would indicate that that people believe that it has been effective, although only 33% thought that it reduced fraud in corporations. So I think some mixed reviews on it, and I think 13 years in, there have been people that have had dreams that it would go away and the level of work would reduce. However, it doesn't appear that that'll be happening anytime soon. So what we'd like to do is, with that backdrop, talk to you a little bit about creation of that kind of documentation specific to the order to cash process, and Kristen will take you through that.
Thanks, Jim. So really the goal of documenting a process is to understand the story from beginning to end in order to be able to identify the controls. So the steps that we typically take in documenting processes are to first obtain any applicable policies and procedures and read through them to get an understanding of the process. Second, we'll take a look at any issues from the previous year. Then we'll typically perform interviews and walkthroughs with key personnel involved in the process. Then we will document the process and confirm accuracy with the process owners. So really performing interviews and walkthroughs, so what is a walkthrough? It's a step-by-step demonstration of the process with key personnel. The purpose is really to understand the process and to understand any review processes that are occurring. And also, you want to educate the person that you're doing the walkthrough with on controls and controls within the process so they understand. And then for each significant sub-process, there's certain things that you would want to document. So how are the transactions initiated, processed, and recorded? Who is performing those processes? How and when the process is performed? What systems or source documents and records are involved within the process? And how are they identifying any incorrect processing of transactions, and how are they resolving those issues? Also, when you're documenting the process, you want to speak to all people involved. I typically like to sit with the individual who actually performs the process instead of sitting with their manager. You want to ask them what happens if they're out sick, who will perform those duties, who will review them, and then ask about reviews and approvals. Are they just putting a signature on a paper, or do they really understand what they're looking for? During your walkthrough, you're going to want to obtain screenshots and a sample document as well. You also want, once you've documented the process, you're going to want to get their sign-off, and that's a really important step. You want them to read through the document, make sure they agree with what you've documented. And typically, we will update the narratives annually unless there is a significant change in the process or the controls, and then we would consider updating it more frequently. You can also consider doing quarterly sub-certifications with the control owners to make sure that there are no changes within the controls themselves. Some methods of documentation you can use. So we typically use either a process narrative or a process flowchart or a combination of the two. With the COSA 2013 update, we've been seeing a lot more of the flowcharts and a combination. So the advantages of using a narrative, they're definitely more detailed, but sometimes they can be too detailed, but they are flexible in the format as well. Flowcharts, you can see the overall relationships within the processes, and it's a little bit easier to identify any gaps. Some disadvantages can be that they're not detailed enough, and they can take a lot of time to prepare.
One thing to point out is ultimately the people that determine whether this documentation is adequate or not really are the external auditors, or the ones that ultimately have to sign off on the internal controls. And some of the trends that we've seen in the last couple of years is that they're looking more for the flowcharts looking for that kind of visual representation of the flow, in addition to the process narrative. So some of their preferences are certainly pointing towards more documentation than less, and we'll talk to you about that a little bit more as we go through.
So as we stated before, the purpose of documenting the process is to identify the controls. So what exactly is a control? It's really any action that's taken by management, the board, or any parties to manage the risk and increase the likelihood that established objectives and goals will be achieved. And there are different types of controls. So you have your entity level controls, which are going to apply to the whole organization. And examples of those are policies and procedures. You have your process level controls, which are more at the process level and address the process level risks, like your account reconciliations. And you have specific transaction level controls, and those are more of your IT application controls or segregation of duties. In addition, we also identify controls as key or non-key. So a key control is going to reduce significant risk. And without those key controls, it's going to be very difficult to achieve the desired outcome or business objective. Your non-key controls are going to be not as essential to the process, but they're going to help it run smoothly. They're going to mitigate risks that aren't significant to the process, and they could be redundant and already addressed by a key control. So that really the purpose of identifying the key controls is that you want to prevent a material misstatement in financial reporting.
And the key controls are the ones that are really relied on for management's assertion, and they're the ones that get the most attention. They're the ones that get tested either on a daily, monthly, quarterly, or annual basis.
In addition, you can also identify both preventive, detective controls. So a preventive control can prevent an undesirable event from occurring. So that an example of that would be a purchase order approval. It's happening before the purchase is made. A detective control would detect undesirable events from occurring. So it would be after the fact, and that would be more of your account reconciliation process. And then you have your mitigating and compensating controls. So a mitigating control is going to reduce the potential impact if an event should occur. An example of that would be an insurance policy that's put in place. And a compensating control would compensate for a lack of an expected control. So if you couldn't properly segregate a process, you would have the review of a system report instead. You're also going to see manual and automated controls. So a manual is performed by a person, not a system. Example again would be a manager's review of an account reconciliation. An automated control happens without human intervention. So example would be a three-way match performed within the system. And then you can have mixed controls, which are a combination of both. An example of that would be a manager's review of a report generated from the system. So now we're going to really get into the order to cash. And this is just a general overview of the key sub-processes that we would typically see within the process. So you have the customers, you have your customer order entry, your order fulfillment, your returns, your invoicing and credit memos, cash receipts and application, collections and write-offs, allowance for doubtful accounts. Then you would have revenue recognition, the recording of accounts receivable, and segregation of duties. And we're going to talk about each one of these sections individually. So for your customers, you really want to determine what your customer base is and how are your customers authorized. Is there any due diligence process on the customer? So are they performing credit checks? Do they have credit applications? Does the customer have a credit limit established? Another area you'd want to look at is pricing. So how is customer pricing approved and entered into the system, and what is really the frequency that pricing is reviewed. Is it done annually? Is it done quarterly? And typically you'll see some sort of management or committee that would review and approve the pricing. Also within the customer process, you would want to look at the contracting process. So do all customers have a contract? Who reviews and approves and executes the contract? And typically what you'll see there is a policy which delineates authority to certain individuals and officers of the company to execute the contract. And then you'd want to look at the customer master maintenance. So who has authorization to enter new customers or make changes to customers within the system? And we've outlined some key risks that you'd want to consider for customers, and we're not going to go through each one, but just highlight some of the more important ones. So you'd want to look to make sure that new customers are properly authorized, that customer pricing is authorized and accurately entered into the system, that no one is making unauthorized changes to the customer master file within the system. So now we're going to move on to the second phase, which is the customer order entry. So how are the orders from the customers coming in and being entered into the system? And is there any confirmation that those orders are being properly processed in the system? And some key risks to consider here are that customer sales orders are inaccurately or incompletely processed, and then that customers' sales orders aren't exceeding any customer credit limit. The next phase would be order fulfillment. So once the order is processed in the system, how is it being transferred and being fulfilled? Is there a pick list that's being generated by the system? And then you're going to move on to shipping. So how are those shipments verified? Is there a packing list? Is there segregation between the individual that's packing and someone else is reviewing the shipment and signing off? And then are they retaining the shipping documentation? And some key risks to consider here, I would say, is that order entry data is not transferred completely and accurately to the shipping department. So you want to make sure that all orders that are coming in are being shipped, and that shipments are inaccurate or incomplete, so that someone's verifying those shipments before they go out the door. So then once the items are shipped, then how are they invoiced? So typically there's an invoicing department that receives the shipping documentation, and they'll process the invoice, create the invoice within the system. So typically that's either an automated or manual three-way match between the sales order, shipping documentation, and then the invoice itself. Is there any review on the invoice? Can the person that's creating the invoice alter the number of items that have been shipped? And then how do they confirm that all shipments are invoiced within the system? And then you'd want to look at credit memos. So how are credit memos requested, authorized, and processed? And how do they really confirm that they only process credits for items that have been invoiced and returned? And some key risks here are that invoices are not generated for valid shipments, that they don't reflect correct pricing, customer information, and or shipping details, and then for credit memos, that they're not authorized or that they're not processed for items which have been previously invoiced. And then we're going to move on to the cash receipt and application process. So how are they receiving the cash? How is it coming in the door? Do they receive live checks? Do they have a lockbox? Or are they charging customer credit cards? And then how are they applying that cash? And how do they make sure that it's applied to the correct customer account? And you also want to take a look at any unallocated cash balances to see what the review process is around that to make sure that they're clearing those balances timely. Some key risks to consider here are that cash receipts are not deposited, so they're coming in the door, but they're not getting to the bank. That they're not accurately or completely recorded in the appropriate period, and then that they're not being applied to the correct customer account.
And those things never happen, obviously.
Never. And then we're going to move on to collections and write-offs. So for collections, how are they monitoring their aged receivable balances, and how is their follow-up with the customers documented? Are they maintaining some sort of log? Is it documented within the system? So how are they really documenting those follow-up conversations that they're having? And then if they determine that something cannot be collected, how are they preparing the write-off? And is it authorized? Typically, you'll see a write-off or credit memo form that has specific levels of authorization on it based upon the dollar amount. And then who's authorizing and who's processing that write-off in the system.
Now that's one area. Obviously, fraud risk is a kind of underlies any of these risks that we're talking about. You can see obviously in the area of write-offs, we would expect to see a lot of documentation around analyzing the nature, extent of write-offs, and some analyzing of the write-off history to determine that what level of fraud could be occurring in that environment.
And some key risks to consider here are that aged AR balances are not monitored and followed up on, that they're not identified and written off timely, that write-offs are not authorized and completely and accurately recorded in the appropriate period. I think sometimes you'll see here that people hold write-offs. They don't want to record them in a certain period. So you want to watch out for that as well, that they're recording them timely. On their allowance for doubtful accounts, you want to look to see if there's a policy. So how are they calculating the allowance for doubtful accounts? Who's authorizing the calculation and who's recording it? How are they making sure that it's calculated and recorded properly within the system? Key risks to consider: that it's not properly calculated and or recorded, and that you have long outstanding balances that are not being reserved for.
Yeah. One thing with the allowance for doubtful accounts, obviously it's a very subjective evaluation, and what auditors will be looking for there is that there is a policy that's used. There's a formulaic method that you go through to calculate that reserve that somehow is compared to your actual write-offs over time, and that any adjustments from that policy are evaluated and approved by senior management, as opposed to that number moving around for reasons that are less appropriate. So that I'd say that of all the areas is one that requires a lot of discussion in the documentation as to how it's determined, when that policy amount would be overridden or changed, and who approves that when it does.
So moving on to revenue recognition, which is probably one of the toughest areas. So really, how are they recognizing revenue? Is it based upon shipment or upon receipt by the customer? Or is it milestone, royalties, prepayments? Is there a deferral of revenue? So really you want to see how revenue is being recorded accurately and completely for all items shipped.
And that's one area where the accounting policymakers are increasingly looking at revenue recognition, disallowing the recording of revenue where right of return exists. And this isn't an accounting lesson, but it is an area that of all of this that's going to require a lot of discussion with whoever an organization's chief accounting person would be to make sure that that's being considered appropriately, because it is as one who's been in the profession for 30 years, it is one of the more esoteric areas, and it's an area where the rule makers are as conservative as ever, and there are items that are not permitted to be recorded as revenue till far down the line that somehow it defies logic. So it requires a great deal of specificity to determine if we're recording it the right way.
Some key risks to consider here are that revenue is not recognized for products shipped, that they're not recognizing it in the appropriate accounting period or classifying it properly, or that it's not being completely or accurately recorded to the general ledger. We're going to move on to the accounts receivable module. And this is really more about how AR activity is being recorded to the general ledger. And typically you'll see it being recorded automatically by the system, either instantaneously or nightly, depending on the system. But you want to look at who has access to open and close the AR module, and is there a reconciliation being performed monthly between the general ledger and the AR aging report. And really the key risk here is that your AR activity is not completely or accurately recorded to the general ledger. And finally, within the process, you'd want to look at segregation of duties. And you'd want to see how duties are segregated between the customer master maintenance, the sales order entry, invoice processing, cash receipts, and application, both in the system and out of the system. Sometimes in smaller organizations, you're going to see that you can't segregate properly. So then you'd want to identify what the compensating or mitigating controls are. So are they reviewing a system report instead? Is there some sign-off on an invoice that would mitigate that risk? And really the key risks here are that the duties are not properly segregated and that access is not restricted to appropriate personnel.
Yes, segregation of duties is one area that gets a lot of discussion, particularly with smaller companies, emerging companies, because obviously most companies start out with one person, so segregation of duties is impossible. And there's also the concept of cost benefit, meaning the cost of the control there should be a relationship of the cost and the benefit. And in looking at segregation of duties, it needs to be reasonable for the size and the complexity of the organization. Obviously, that's going to change given the size of the company, and it's something that needs to be considered in the documentation.
And also within the process, you can take a look for any IT application controls. You do want to make sure that your IT system, the general computing controls, have been tested and can be relied upon. But these are some key application controls that we typically see, so that the system generates unique sales order numbers or invoice numbers, that the system is performing a three-way match between the sales order, the shipment, and the invoice, that is preventing the user from changing the quantity shipped when they're creating the invoice, that it prevents them from posting an invoice to a closed accounting period. The system may also be recording the accounting entries for revenue and accounts receivable and calculating the invoice extensions and totals. So some potential pitfalls that we typically see when we're documenting the process is that when you're sitting down with the process personnel, they're not being completely honest with you. They're telling you what they think that you want to hear and not really what's happening within the process. They also sometimes describe what the process is going to be, not what it currently is. And really that they're telling you about controls that they're not documented or evidenced. So
what does all this mean? I mean, these are the for this particular process, those are the key areas that would need to be reviewed. And as a practical matter, if we were starting this from scratch, this would involve the interviewing all of the folks that have a part in these different steps that we described here, and understanding what they do, understanding what checks they make, what controls are in place, and documenting those and putting them into the narrative that we described, and probably supporting that with a flow chart. And once that is done, normally for an average size company, that documentation would be several pages long, probably 4 or 5 pages long, describing what went on, attached with a flow chart. And then what we would need to do, what would happen at that point, is that, and this is still on the company side, this is before anything gets turned over to the external auditor, is that we'd look at that documentation, we'd actually walk a transaction through and say, okay, this is what the documentation tells us. Is this really happening? And lo and behold, you'd find that there's usually some changes that occur. It's a very iterative process. People describe things in one way. There could be a difference in how they describe it, how they recall it, difference in how it's documented and what goes in there. So that's why the walking through of the process is extremely important to validate that that's actually what's happening. And then once that occurs, key controls would be identified. Once we're comfortable with the documentation, key controls would be identified, and then those controls would be tested to see if they're actually operating as described for a sample of items. This would occur if we're talking about a company that's a December 31st year end. This would all occur sometime in the second or third quarter. The testing would continue through the end of the year. All along, this documentation, assuming we're dealing with a public company that has to get its internal controls attested to by their external auditors, all of this would lead up to turning the information over to the external auditors, and for them coming back, again, with more suggestions, more questions. It's very iterative, and usually it ends right around the time that the 10K gets filed. It goes right up until the end of the audit. What we're seeing as a practical matter in that process, and for those of you that ultimately are preparing this documentation, is that I mentioned the PCAOB earlier, the Public Company Accounting Oversight Board. And what they are, they police all the accounting firms that sign off on financial statements of public companies. And my firm actually is one of those companies. We get reviewed by the PCAOB on a cycle depending on how many you audit. The large firms, the firms that audit the majority of the large cap companies in the United States, are reviewed every year. Internal controls over financial reporting is one area where the majority of the comments, and what happens is the PCAOB goes in and reviews a sample of audits on a very detailed basis that each firm prepares, and gives commentary on how good or bad they think that firm did in different areas of the audit. And in some cases, they've even told the firm, we don't really think you did enough work to support your opinion. And that's obviously one thing that as an audit firm partner, that's the last thing you want to see, or the last thing you want to have come at you. So what they've done, what's happened over the last few years is the PCAOB in their reviews has been extremely critical of what the major firms have done in the area of internal controls over financial reporting. And many of the comments that come out are related to the work that's been done there, and concerns that the PCAOB has over how much work they did, with some very specific comments around the type of documentation, the extent of testing. And one example I'll give you is for one of our clients where we help them prepare this kind of documentation. There was one particular process that I read the documentation. I thought we did a very good job of documenting this one particular cycle, and it was about 2 pages long, and the external auditor came back and they said, look, we kind of reworked this into what we think it should be, and it was twice as long. And it was really adding specificity around somebody compares one document to another and determines if they agree. And for most people, I think that would give you an idea for what they did. However, what they wanted was, what happens if they don't agree? What happens if this reconciliation does not come out? What are the steps that you go through? Who do you talk to? Who do you get approvals from? And it's a very, very granular level of documentation that is being looked for right now in this area. So what I tell people when they start doing this for the first time is pride of authorship should go out the window, because there's going to be many, many changes. We have folks on our team that do this for the first time with new clients, and what you start with and what you end up with looks very, very different. But I think it's good that we're having this discussion with credit professionals, because the best model within companies is for the people that are really involved in the processes to do the documentation and guide, if there's internal audit involved or outside service providers, guide them through what actually happens, because they're the ones that are in, that are kind of in the day-to-day battles, and they really know what's going on. What you see all too often is companies send legions of other people in there to go in and document it, and the learning curve is just so significant. So for you all to be involved in this kind of documentation is really the most efficient for your companies, and I think will bear the greatest result. This will not change. I think we talked about in the beginning some surveys on the effectiveness of Sarbanes-Oxley. I think it's been softened up as much as it's going to be softened up. There is some empirical data that it is working. However, the other side of that is this thing went in 2002, was probably as implemented as it was going to be by the end of 2004, and the economic meltdown still occurred in 07, 08. So it certainly didn't prevent that. But as far as giving people some assurances to the veracity of financial statements, it certainly has had a very positive impact.
All right. So with that, we're going to open it up to a question and answer section. If anyone on the line does have any questions, you can feel free to type them into the questions box in your side panel, and we will pose them to the presenters. All right, the first question we have here is, what would you say are the either one or two biggest takeaways that you could give from this presentation?
I think, as with everything, start early, because these things do take a great deal of time. We were even a little surprised as we went through and looked at some of the key risks and some of the things to consider. There were, we had dozens that we talked about here. So in the current environment, with the oversight and with the level of specificity that's being looked at in this kind of documentation, give yourself as much time as possible, have it get through as many iterations as possible. The second is to really test it out. People describe things differently. People forget certain things, and that walkthrough is extremely important. And I think the other would be patience, because the next person you hand it off to is going to have significant comments, and things will change, and there's going to be a lot of red ink on these things.
All right, great. Another question we have here is, how does this all apply to private companies?
Good question. Right now, private companies are obviously exempted. Sarbanes-Oxley only applies to publicly held companies, and there's even many layers of public companies that are exempted from it for size or for foreign ownership. I do think what it has created, what it applies to any company that gets audited, is that the awareness of internal controls is much greater within the accounting profession than it was before Sarbanes-Oxley. The joke I used to tell is that that cracking sound you heard around the time that Sarbanes-Oxley went in was people taking the shrink wrap off of their books on internal controls and cracking the spines, because everyone talked about internal controls, but it really was a very small piece of what occurred within companies and with audits. So I think it does have impact beyond public companies, but it's much less significant than for actual filers that have to deal with this on an annual basis.
Okay.
Jim, what are some of the penalties or fines, or if someone isn't compliant and they're found to be not compliant, what occurs?
Well, it's really focusing on companies. Public companies, again, with all of this, you're evaluating your internal controls, you're telling your external auditors that everything's okay, and then they're doing their own testing to see if they agree with it or not, and they put that in their opinion. If they determine that your controls are inadequate, or that you didn't document them appropriately, or you didn't test them appropriately to give your opinion, they would report. They are compelled to report what's called a material weakness. And a material weakness is a significant deficiency in internal control, and that would go into the opinion. Lesser items get reported either to the board or to management. The thought was that reporting material weaknesses could have significant impact on market cap, and there are differing studies on that, but in the early days it was shown to have very minimal impact on market cap. So obviously, the SEC can take action. The SEC could block registration statements for public offerings and things like that if you're not compliant. However, the teeth in it has not been there, but people aren't testing it either. Anything else?
I don't have any more questions online, so just to let everyone know, as you can see here, we have both Jim and Kristen's contact information. If anyone does have any more questions that they think of after we are off the webinar. And I also just wanted to let everyone know that we will be sending you all a copy of the presentation slides from today's presentation. So with that, we're going to shut everything down. I want to thank both Jim and Kristen for presenting to our audience today. And thank you all for taking the time out of your day to listen to our presentation. If you guys also could fill out that brief survey as you exit the webinar, it's very helpful for us to continue to make these better for all of you. So I hope you guys enjoy the rest of your day.
Enjoy your holiday weekend.
Have a great weekend, everybody.
Okay.
Take care.
Thank you.